Hello fellow compounders. In previous videos we learned about coffee can investing. This is where we invest in growth companies and let the investment compound undisturbed for a long time, with the expectation of catching 100 baggers. In this video, we are going hunting for stocks to add to my 2023 coffee can. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor and you are responsible for your own financial decisions. My expectation is for the investments to return 100 times the initial investment. In other words, to be 100 baggers. I'm looking for growth companies that have a long runway, businesses that I believe will continue to be successful over the next 10 to 20 years, and that I can buy at a reasonable price. I'm looking for what Peter Lynch calls growth at a reasonable price. Here's the screen that I'm using. First, a forward price to earnings growth ratio less than 1.5. The forward PEG is calculated using the 12-month forward PE divided by the average earnings per share estimate for the next 5 years. Second, a trailing price to earnings growth ratio less than 1.5. The trailing PEG is calculated using the PE divided by the average earnings per share growth rate for the past 5 years. I'm looking to pay a fair to good price for growth. Third, a 5-year earnings per share average growth rate greater than 15%. Fourth, a 5-year average sales growth rate greater than 15%. Fifth, a return on invested capital of greater than 15%. This confirms that the business has a competitive advantage. And sixth, a market cap greater than 500 million. This will exclude microcaps. The screen produced 69 candidates. I reviewed the list and came up with 3 stocks that I would consider adding to my coffee can. Stock number 1, Taiwan Semiconductor, symbol TSM. Taiwan Semiconductor is the largest dedicated chip foundry in the world. It had around 57% market share in 2021 according to Gartner. Taiwan Semiconductor was founded in 1987 as a joint venture between Philips, the government of Taiwan, and private investors. It went public in 1997. Taiwan Semiconductor's scale and high-quality technology allows it to generate solid operating margins. It has a well-recognized customer base, which includes Apple, AMD, and NVIDIA. Taiwan Semiconductor produces the chips for the iPhones. It also is building 2 chip manufacturing plants in Phoenix, Arizona, for $40 billion, bringing the most advanced chip manufacturing to the United States. It's trading at a forward price to earnings growth ratio of 0.6, which is very attractive. And its trailing price to earnings growth ratio is 0.7. Its 5-year earnings per share growth averaged at 20.7%, and its 5-year sales growth averaged at 16.2%. And it's expected to grow annual sales by around 16% for the next 5 years. It has a return on invested capital of around 25% and a wide moat. This is primarily due to its technical competency. In 2015, there were 6 companies that could produce cutting-edge nodes of 14 and 16 nanometers. Currently, there are only 2 companies, Samsung and Taiwan Semiconductors, that can produce the 5 nanometer chips. It has a market cap of $396 billion. At around $78 per share, Morningstar gives it a 5-star rating and a fair value estimated at $133 per share. It's currently trading at around a 41% discount. And by the way, Warren Buffett recently added Taiwan Semiconductor to Berkshire Hathaway's investment portfolio. Stock number 2, Malibu Boats, ticker MBUU. Malibu Boats is a leading designer and manufacturer of powerboats in the United States. It's the market leader in performance sports boats under its Malibu and Axis brands. It owns Cobalt Boats, which is a leading producer of stern drive boats in the United States. It also owns Pursuit Boats, which makes high-end offshore and outboard motor boats. In 2021, it purchased Maverick Boat Group, which is a leading seller of flat fishing boats. Malibu's target market includes a wide range of water enthusiasts with active lifestyles. It's trading at a forward price to earnings growth ratio of 0.5, which is extremely attractive. Its trailing price to earnings growth ratio is 0.1, and its 5-year earnings per share growth averaged is 52.8%. Its 5-year sales growth averaged at 27.8%, and it has a return on invested capital of around 25%, which signals that it has a competitive advantage. It has a market cap of $1.2 billion. It's currently trading at around $57 per share. Morningstar gives it a 5-star rating and a fair value estimated at $100 per share. It is currently selling at a 43% discount. I like it because it's led by its founder and it has been a consistent grower, and I can buy it cheap due to fears of a recession. I expect that over the long run, people will continue buying recreational boats. Stock number 3, Signature Bank, ticker SBNY. Let me start with a big warning. Do your own research. This investment is not for the faint of heart. Even though FTX wasn't a client, Signature Bank ended up being collateral damage of the FTX and the Sam Bankman-Fried fiasco. The stock has declined over 67% from its high last year. A lot of people are turned off from anything related to cryptocurrency. Signature Bank is a New York-based commercial bank. It has 2 operating segments, which are commercial banking and specialty finance. Most of its revenue comes from commercial banking, which consists primarily of commercial real estate lending, commercial and industrial lending, and commercial deposit gathering activities. Specialty finance consists of financing and leasing products, including equipment, transportation, taxi medallion, commercial marine, municipal, and national franchise financing and leasing. Signature Bank has one of 2 payment platforms that provide service to cryptocurrency exchanges. This is the main cause for the bearish sentiment today. The market fears that the outflow of digital deposits could hamper the financial strength of the bank. Deposits are money that people keep in the bank. Digital deposits refers to money crypto exchanges keep in the bank. I believe that the crypto impact is already more than discounted in the price. Here's why. Number 1, the deposits of crypto companies account for 23% of the bank's total deposits. In a draconian scenario, if all the digital deposits were to be withdrawn, the loan to deposit ratio will be 93.1%. This means that the bank is covered. It didn't lend out more than it has in deposits, even if it excludes the crypto-related deposits. So no sale of assets would be needed. That means that it has enough money or didn't overlend based on the deposits that it has. 2, Signature Bank still gets deposits that are not related to crypto, which offset the crypto deposits withdrawal impact. In the 3rd quarter, digital deposits decreased by $3 billion, but the total deposits only decreased by $1.3 billion. 3, cryptocurrency-backed loans account for only 0.14% of its $73.8 billion loan portfolio. That is only $100 million out of $73.8 billion. Signature Bank didn't go overboard lending against cryptocurrencies. Even if all the crypto collateral went to zero, it'd still be okay. Here are the reasons for considering Signature Bank for my coffee can. Number 1, it is selling at 95% of its book value, which means that I can buy $1 worth of value for 95 cents. Number 2, it is a perennial compounder. Over the past 10 years, its loan portfolio has grown at a compound annual growth rate of 22.5%, and its earnings per share has increased at a 18% compound annual growth rate. Number 3, its loan underwriting is conservative. Its average net charge-off is 0.25%, a quarter of a percent, versus 0.91% for the largest 50 banks in the United States. It looks like a well-run bank. Number 4, it passes our growth at a reasonable price filter. Its forward price to earnings growth rate ratio is 0.9 and its trailing price to earnings growth ratio is 0.2. It has a 5-year earnings per share growth average rate of 23.5% and a 5-year average sales growth rate of 15.2%. Its return on invested capital is 18.4%, and it has a market cap of $7.3 billion. Here are my reasons for not investing in Signature. Number 1, its closeness to the crypto world gives it a potential for additional unknown collateral damage. Number 2, Signature's operations might come under additional regulation due to FTX and other scandals in the crypto space. And 3, more than half of its loan portfolio is in the commercial sector, which the market might consider riskier than traditional mortgage banks. I believe that I can make money in this bank due to the overreaction of the market. At around $117 per share, I would be getting a solid compounder for below its book value. So my downside would be limited. However, this investment will take a lot of patience, which is exactly what a coffee can forces you to have. In addition to these 3 stocks for 2023, I'm still buying Microsoft, ticker MSFT, and Alphabet, ticker GOOGL, which were on last year's list. I did a separate video about them a couple of months ago. Here's the link. Or there.